Hi, class. I thought I would talk to you for a few minutes about the budgetary side of accounting for governments. So I want to start off with kind of a simple example. If you were running your household and you were going to budget, and so say you estimated that your salary, and we're going to ignore taxes for now, okay, is say $2,400 per month. Okay. And you have monthly expenses. Okay. Your monthly expenses will say be, just for argument's sake, this isn't for necessarily accuracy's sake, is $1,800 per month. Okay. And so that leaves you with about $600 in discretion there. So this would be for discretionary spending. You'd have about $600 per month. Okay, so that's the given information that we have. All right. So if we were going to be looking at doing a budget based on this, then you would have this stuff for each month. And you would go in, and as you recorded expenses, we all remember that for expenses, those have a debit balance. Okay, so we debit expense accounts, and for revenues, it's a credit balance. So we credit revenue accounts when we're recording revenue. When you're doing budgetary accounting, which is what they use, and again, this is in the governmental funds. It's in the governmental funds only, and that includes your general fund, your special revenue funds, capital projects, debt service, and permanent. Okay, so those five. This is where budgetary accounting really kicks in, and this is required. So budgetary accounting is required by law at the local government. So when you're talking about cities and counties and state governments, they actually record their budget as part of the accounting system. So since we know that expenses have a debit balance and revenues have a credit balance, and we know that if we want to know what we have left to spend, right, in terms of authority, it's budget minus actual equals some remainder, okay, whatever's left, all right, they have to be opposite. So if the actual expenses are a debit balance, it means the budgeted expenses, so budgeted expenses have to be a credit, okay? If we're dealing with revenues on the revenue side, so this is for expenses, if we're dealing with revenues, we have the same thing, the budget minus the actual equals some remainder, okay? And we know that the actual is a credit, the actual revenue account is a credit. That would mean the budget account has to be a debit, okay? So when you are budgeting expenses, the entry of the budget into the accounting system is a credit entry. And for revenues, to enter budgeted revenues, that has to be a debit. So it's exactly the opposite of what you have up here, okay? And that allows this equation to work inside the accounting system. So when you think about it, visualize a T account, okay? And so if this is the actual expenses here, the budget expenses are on this side, okay? And you end up with, you either overspend, right? Which would mean that you have more actual expenses than budget allowed. So that would be an overspend. So you'd have a budget remainder that would be over in the debit column. If the budget minus actual is a positive number, meaning you've got remainder left, that means the budget number is higher than actual, then the remainder ends up over on the credit side. Okay, that's a simple way of thinking about the way the budget process works in government. So again, this is after they go through all the budget hearings and negotiations, because essentially what this starts off with is the budget process starts at kind of the lowest level. Agencies, departments, they're required to submit budget requests, and they filter up to the highest level in the organization. At a state level, it goes by kind of agency, and at the local level, it would be by departments. And so they would then submit their budgets, and it would all come into, say, the executives. So budgets in the state government flow up to the governor's office and into a budget proposal that goes to the state legislature. If it's at the county or the city level, it's going to be the county administrator, or it'll be the city manager who will be preparing a budget request to go to either the county commission or the city council. And so they'll be submitting their budget. And then the legislative body deliberates on it. At the state level, that would be your assembly or House of Representatives. At the county and city levels, it's just the county commission and the city council that are going to be looking at this. Typically, there will be budget hearings held, before they finally come up with a bill that is going to be debated on the floor of the legislative body, and then they will vote on it. If it is passed by all the legislative bodies that are supposed to vote on it, then it goes again to the executive level office, governor, mayor, for final approval. And then, of course, it becomes a law or an ordinance at that point. The process may vary just a little bit from state to local level, but again, this is a formal process. It's not like a business where you kind of work up a budget and say, I think this is the budget we're going to have, and somebody says yes or no. And that's as far as it goes. You may track it using an Excel worksheet or something like that, but it's not part of the official accounting records of the organization. But in government, it is an official part of the accounting for the organization, and so they actually will record it. And they'll be, when we're dealing with revenues, typically what we're talking about with revenues is we just call them estimated revenues. And on the expenditure side, we call them appropriations or appropriated expenses. Now, when we're dealing with governmental funds, remember the terminology. I'm talking about revenues and expenses because I was trying to equate this or explain this using just a simple household budget. But when we start talking about appropriations at the fund level, at the governmental fund level, what we're actually talking about is expenditures. Okay, and essentially, just so I'll give you a quick, to wrap this particular video up, I will tell you that expenditures versus expenses. Let me go to a new page here. Simple example. So we buy a machine, okay? Doesn't matter what it is. We buy a machine and say the machine cost us $100,000, okay? We pay for that machine and say we paid cash for it. Now, in the accrual accounting world, we might say that this machine has a 5-year useful life on it, and we're going to use straight line depreciation on this. No residual value, so we don't have to worry about that. And so we divide 5 into 100,000, and that becomes $20,000 per year will equal our depreciation expense. Okay, so that is our estimate. So over the 5-year period that we have this machine, we're going to expense it. So when we look at our income statement, we're going to show depreciation expense for this item is going to be $20,000. All right, so that's what you'll show there. Now, what's an expenditure? Why do we have this term expenditure? Well, the expenditure equals the $100,000. It's what we actually spent on the item. And so when you're talking about the governmental fund, and we talk about expenditures, okay, this $100,000 piece of equipment can be an expenditure of the governmental fund, but it's going to show up in the government-wide statements as an expense. That's the difference with the modified accrual accounting. Modified accrual accounting, it's going to show up as a $100,000 expenditure in the fund. So it's an outflow of cash during the current period of $100,000. In the government-wide statements, which are a full accrual statement, it's going to show up as we would normally see it show up in a private company's financial statements as being expensed $20,000 per year. So we have the matching of revenues to expenses for the accrual accounting. Here, the concern is the inflows and the outflows. And so here there was an outflow of $100,000 in cash, and so we call that an expenditure. So here we have an expense, here we have an expenditure. So that's the difference, okay, between the terms. And this is probably the most basic example I can come up with to explain it to you. And if they did not use cash and say they were to acquire this, they might use a capital projects fund to acquire the machine and then use a debt service fund to raise the money to pay it back. And so they actually separate the asset acquisition from how they're going to pay for it, so that they would actually use the capital projects fund and the debt service fund. And these two would interact with one another for the purchase of this item. And so they would set up in their fund, they would have a place for this $100,000 machine to show up, and the servicing of the debt would occur within the debt service fund. Now, this all rolls up to, these are both governmental funds, okay? And then what happens is, again, this $100,000 piece of equipment that shows up as an expenditure, okay, in the governmental fund, again, is going to show up as an expense of $20,000 per year over 5 years in the government-wide statements. It is also going to be true that the depreciation expense will also be used, the full accrual accounting here, for proprietary funds, which is your internal service fund and your enterprise funds, and then also in those internal service funds, remember they kind of relate to the internal customers. The enterprise funds, that's when your customers are external. So internal service is customers inside the government, other government departments or agencies. Enterprise funds, you're dealing with citizens and external stakeholders that are purchasing things from the government. Okay, those are going to use the full accrual accounting system, and they will have their assets, their long-term assets recorded on the books, and they will use depreciation to record the expense. But over in the governmental fund side, that's where we're going to be looking at the expenditures, not the expenses. And so we'll be looking at the $100,000, the full amount. Okay. And so if money is needed, if funds are needed to pay for the project, it's going to come from the debt service fund. Okay. So if it doesn't come directly from cash, then it would come from the debt service fund. So that hopefully will give you a good, at least broad overview. I'm going to try to follow this up with some more help. I hope you guys are going to ask questions about this, because there's just so much going on here that it probably helps for me to see some actual questions, but I wanted to at least be able to explain or give you a brief overview.